Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
All right, hey everybody, Brian Fouch here, and welcome to Take Back Control Tuesday, and welcome to the Money Multiplier presentation. So guys, in this presentation, we're gonna be going through, obviously, one of the concepts that a lot of us are aware of when it comes to taking back control of, our money. But, one of the things that when I look at, life and things that we want to have, control is one of the biggest things. And, you probably heard me talk about this before if you've been on this presentation before, but control to me is a big deal. Now, when I say control, what am I talking about? Well, what do we want to control in life? Well, one of the biggest things we want to control is our time. Time is one of those things that is limited. Once it's gone, it's gone. We cannot get time back. So do we want to control time? I mean, do you guys want to control time? Obviously, yes. Controlling time is very important. It's the one thing that I want to control the most of because, once again, it's limited. The second thing is money. Like, we want to control money because controlling money is how we can build wealth. If we don't control our money, just like time, by the way, somebody else is going to control it for us. And we don't want someone controlling our time and our money. We want to remain in control because when you control money, what else can you control? Time, right? And the last thing we want to control is our mind or our mindset. If you don't control your mindset, someone else is going to do it for you. And when you look around the world at marketing, at TV, at these little devices called cell phones, they're all about controlling our mindset and our focus. And that allows people to control our money and our time. So once again, control is very powerful. That's why this presentation or this webinar is called Take Back Control Tuesday. Taking back control is one of the most important things that I believe that you can do in life. And the concept we're going to be talking about here today, the infinite banking concept, is about control, mainly about controlling your money and the banking functions in your life, which then can allow you to control the other things in life, which is time. Now, as we get into the presentation, one of the things I'm going to talk about first is the mindset, because with this concept, we have to understand how we think about money, but also how we might be thinking about money incorrectly, because that mindset we may have learned might not be correct. And so that leads me to this quote that we here at the Money Multiplier, we like this quote, and it's by Will Rogers. And that quote is this: the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. That's a very, very important thing right there, because we think certain ways about money. We think that's the right way, but if you don't know that there's another way to think about it, you don't know that the way you're thinking might be the incorrect way. Okay. So my point about this is I want you to keep an open mind as we go through this presentation. Keep an open mind, especially about the concept we're going to be talking about. Keep an open mind around money, because I am going to be challenging the way you think about money. Does that make sense? Now, let's say you get 100 18-year-old kids all gathered in a room and you ask every single last one of them, where are they going to be when they retire? Oh, every last one of them is going to be telling you that they're going to be wildly successful. They're going to be millionaires, maybe even billionaires. They're not going to say that, oh, I'm going to be, poor or unsuccessful. No, they're going to be successful, right? We want to be successful. Yet here's the fact of the matter. When you fast forward to retirement age, of those 100 18-year-olds, how many are going to be financially secure in retirement? It's only 5%. 5 out of those 100 18-year-olds will be financially secure in retirement. And that's crazy, by the way, because if you think about where we live, North America, United States, Canada, the most successful or wealthiest, one of the wealthiest countries in the world, Yet for some reason, only 5% are successful in retirement. With all these resources, with all this knowledge, all this access, only 5. So let me ask you a question, and use the chat box, guys. Use that chat box. Put in questions into the question box. Put questions into the chat box as we go through this. I'll answer them as we go through this. But let me ask you a question right now, though. Do you want to be one of the 5 or one of the 95? If you want to be one of the 5, put a 1 or a yes or a Y in the chat box. Want to make sure you guys we're in the right spot, right? Want to make sure you guys want to be one of those 5, because this presentation is about being one of those 5, the 5%, not about the 95, right? So give me a 1, give me a yes. Okay, there you go. Lucy, yeah, of course, you want to be Art. Yeah, happy Tuesday. There you go. But yeah, yes, guys. So we want to be one of those 5 people, okay? We want to be on that side of the equation. So once again, as I said, as we go through this, keep an open mind, because you got to keep an open mind to be one of those 5%. All right, now this is not just something I pulled out of thin air, by the way. This is a real stat from the Social Security Administration. They say 5 out of 100 people will be financially secure at retirement age. Well, we want to be one of those 5, and this concept we're talking about here today is about being one of those 5. Now, a little bit about me. Going to go through this pretty quickly because you guys don't really care about me. We want to get into the meat of what we're going to be talking about here today. So I did follow that traditional path through life. I went to school, got a degree. That's my degree there, Washington State University. Go Cougs. I have not used that degree in probably over 10 years now. It's been quite some time since I used that. And I followed that traditional path through life, right? The hard way, as I call it. I was raised lower class. My family, great family, but obviously we had to use wood heat to keep ourselves warm in the wintertime. I remember getting up in the mornings, freezing cold in the winter, going downstairs, starting the fire to get the house warmed up, all that kind of stuff. But that was just normal to me. But I was taught, work hard, get good grades, go to school, all that kind of stuff. And I did that. I went to school, got the degree, got a job in corporate America, was saving money to a 401k because that's what I thought I was supposed to do. It was the only thing, by the way, that I was aware of. I didn't think there was any other option. I thought 401k, that's where it goes. And I had the house with the mortgage, the cart with the loans. I had the credit cards with the debt and the growing family. I had all of these things, and I was told that was the American dream, but I was drowning. I was drowning. And I could barely keep my head above water, yet everybody's like, hey, good job, right? I'm like, what's going on here? Good job. And then something happened. I read this article in a magazine, and this was a big turning point for me. I had quite a few turning points, but this was one of the first ones. And it was this magazine article in a financial publication I was in a doctor's office, by the way, in the waiting room. And it said, hey, average millionaire knows their net worth. Okay. I don't know mine, and I'm obviously not a millionaire. So I was like, oh, geez, I wonder what my net worth is. So I've been working for over 10 years in the construction industry. That's the paper right there. I lost the paper, but I took a picture of it, fortunately. But I was worth a negative amount of money. And I was like, wait a second, this makes no sense. I'm working my butt off. I'm worth a negative amount of money. And then when I looked at the future, I was going to be worth less year after year. Yet I'm like, wait a second, I'm supposed to be making more, but I'm making less. I was like, this is insane. And I'm doing what everybody else around me was doing. So I was like, what the heck is going on? This is a nightmare. And so I kind of said, hey, I got to do something different, but I didn't know what it was. And then another event happened. This is pretty personal. My grandfather, he worked his entire life. He was a baseball coach, football coach at a local high school that my dad and my brother went to. And everybody loved him in the community. Very, very, very popular guy, but worked his whole life up until his 60s to have that great retirement so that he could then travel around the country and watch his grandkids, sporting events. And he did. He retired, bought a motorhome, did that for about a year, and then he got very sick. And he got Parkinson's, he got leukemia, got some other things. Fast forward, he couldn't travel, and then he ended up passing away, barely into his 70s. And I was just like, what? This is horrible. And it kind of had a big impact on me is that if I keep doing what I'm doing, am I going to get the results that I want or the life that I want? No, because it's not promised. It's not promised. Tomorrow's not promised. And I realized if I want to have different results, I've got to do something different today. I cannot wait down the road to live that life that I want. And maybe you guys feel the same way. Like we want to live that life today. And so working all this time to eventually get the results we want down the road was not something that I was okay with. And so I made a change. And part of that journey, it introduced me, by the way, to the concept that we're going to be talking about here today. And it's one of those things that you can use it to take back control and to live the life that you deserve today. and also down the road. So that's why it's a big deal to me. And obviously, when I made that change, I got into entrepreneurship, got into business ownership, and had success, and had failures too, of course. But anybody can say anything on the internet. So I want to show you guys some of the things that I've done, just so you guys know who you're talking to or who's talking to you. So this was a business I acquired in 2016. In 2021, COVID, of course, was hit. Was going on right there. This business did over a couple $1 million. Was on the Inc. 5000 list. I didn't think that was possible, by the way. I was like, fast forward, or actually rewind 10 years. I never thought that could be me. And yet when I did it, I didn't even phase me. I was like, oh, okay, this is normal now, because my normal changed. But what changed though? It was my mindset. So that's why I say mindset is one of those three things you want to control, because when you control it, you can do pretty cool things. And so, my life today is very interesting. I love to control my time. Money is fine, but time is the biggest thing for me. I travel. The last time I did this presentation, I did it a while ago, I was in an RV with my family. They're not playing around. I'm doing the presentation. I'm actually going to be traveling in my RV this coming weekend. I control my time. And so I've done a lot of fun things in life, have had a lot of experiences. I've built a big network, but I'm very grateful though, because I've been able to share these kinds of things with people like you, share these concepts, share these methods, share what I've learned with others. I have a purpose in life, and that's a big thing for me, is having purpose. I actually coach people on finding their purpose. Without that, I think we're kind of lost. And so for me, part of my purpose is to free myself and others so we can live and heal our lives. And that's what I love doing. That's why I'm here talking to you right now. So we can, this is part of my passion. Now, one thing I want you to understand though, that what I'm talking about today, as you go through the slides and you see the content, this is not something new. This concept might be new to you, but it's not a new concept out there. It's been around for several hundred years, and there's a lot of other people out there that have been talking about it or have talked about it. You probably have heard about this concept in one form or another. But who's talking about it? Well, you ever heard of Robert Kiyosaki? That's someone that I work with a lot of his advisors, by the way, and they all know infinite banking. They all talk about it. He talks about it in his book, Second Chance. Tony Robbins talks about it in his book, Money Master the Game. This is the book, Becoming Your Own Banker, Unlocking the Infinite Banking Concept, which, by the way, I have it right on my desk right here. I like this book. I read it all the time. By R. Nelson Nash. He's the one that popularized this concept. Mapping Out the Millionaire Mystery. So this is one of my mentors, Chris Naugle, and then Brent Kessler. So they talk about it in their book. They wrote Mapping Out the Millionaire Mystery. And then also Chris talks about it in his book, Private Money Guide, right there. Now, I do recommend, by the way, that you read these books. Increasing your knowledge to me is one of the most important things that we can always do, always be increasing our knowledge. That's mindset right there. But these are some good books that can really open your eyes to this concept and also how money truly works. Who has used this concept, this strategy throughout history? Well, I always mispronounce his last name, Jim Harbaugh. I say his last name, but yeah, they talk about it. This is in 2016, by the way. Cash value life insurance makes Harbaugh the Harbaugh College football's top paid coach. Pretty cool how they did that. I'm not going to go into how they did it, but it was amazing how it worked. Pretty cool. You ever heard of this guy? I kind of forget his name. His name is Joe Biden. He probably doesn't know his own name. Just being honest there. Yeah, he has about 6 of these policies. Gee, I wonder why these people have these, right? By the way, Disneyland, Walt Disney. So Walt Disney, if you ever know his story, was trying to get Disneyland off the ground, and no banks would give him financing. So he used this concept to access cash value or cash to create Disneyland or Disney World. So think of it this way. Without this concept or this strategy, Disney World or Disneyland would not exist. Like, that's kind of mind-blowing to me right there. Also, McDonald's hamburgers. So Ray Kroc, the gentleman who essentially took over the McDonald's or took it out from underneath the McDonald's brothers' feet, he used this policy, this concept, to essentially cash flow the business for the first 8 years. So without infinite banking, without this concept, McDonald's, one of the most iconic fast food restaurants in the world, would not exist. Like, that's amazing to me. The Pampered Chef, she used $3,000 from this concept, life insurance, as we'll explain it, to create the Pampered Chef, which Warren Buffett acquired for $1.5 billion. Okay. Also, what other families have used this? The JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, and here's the fun thing, now you can use this concept as well. It's not reserved for the wealthy. They just have different access to knowledge, right? Advisors, and so they can do these kind of things. But when you have the same access, which is what we're talking about here today, you can do the same thing that they're doing. Build wealth, have control, generation wealth, and so much more. All right. Now let's talk about what infinite banking, which is the concept, of course, it's the money multiplier method, but it uses infinite banking, what it will do for you. So one, it creates guaranteed generational wealth day one. Day one. Okay. Now, guaranteed, very important word. Generational wealth, something we all probably want. Some of us want to have that, but it does it day one. Not year 40, not down the road, but day one, that is guaranteed to be passed on, by the way, tax-free. That's pretty cool. Jennifer, yes, there will be a recording. It allows your money to grow uninterrupted, compounded for the rest of your life, guaranteed. Once again, that word guaranteed, right? But it allows your money to grow uninterrupted, compounded. So compounding is very, very powerful when it comes to building wealth. Okay. It does that for the rest of your life, guaranteed. I don't know of any other vehicle that does this. Why do you think the wealthy do this concept, right? Makes sense? Okay. Takes control of your money away from the big banks and Wall Street and puts the control of your money into your hands. What did I talk about at the beginning? Three things. Control. Control of what? Money. This puts the control into your hands. If you don't control your money, if the banks control it, if Wall Street controls it, who's making money off your money? They are. When you control your money, who makes money off your money? You do. Okay. This is how you build wealth. This is why the wealthy do this. Make sense? There you go. Protects your money from lawsuits, from bankruptcy, from divorce, and creditors in most states, by the way. Protects your money. So if you're building wealth, what's the best way to preserve that wealth? Protect it, not to lose it, right? Do not lose it. A lot of wealth is stolen or taken away or lost because it's not protected. This protects your money. It protects it. It's a protected asset, by the way, in most states. That's amazing. It also allows you to be the bank for things that you may normally use a bank for. What are those kinds of things? Real estate investing, college, cars, homes, investments, retirement, all of those things, while still having the exact same benefits listed above. So the interesting thing about infinite banking is it does all of these things at the same time, not one or the other, but all of them at the same time. Imagine being your own bank for things like real estate investing, building wealth, by the way, while still having uninterrupted compounded growth, guaranteed, also while having guaranteed generational wealth, guaranteed once again, and protection of your money, all at the same time. So give me a 1 in the chat box if you would like to have all of these things in your life at the same time. Give me a 1, give me a yes, give me a Y in the chat box. Would you want to have these things in your life? Very rarely do I ever ask that question and someone says no. If they say no, I'm like, ooh, okay, what's going on? What's the alternative, right? What's the alternative? What do you want to have if you don't want these things? Okay. If you want to build lasting wealth, this is one of the best strategies I've ever seen to do that. Probably the best, by the way. Okay. Now, as we go through this, please take out, the pen and paper, take notes if you want to, use the chat box, use the Q&A box if you want. Make sure you guys ask questions, because the more questions you ask, other people aren't asking them, the more clarity you're going to get, the more this will make sense. So be sure to make or take notes or ask questions, that kind of stuff. All right. Now, mindset. Mindset is very powerful because when we go through life, we are taught certain things, especially at a young age. When we're young, do we know right or wrong, black or white, good or bad? No, we don't. And same about money. We don't know things about money. So we're taught about money. So here's an analogy about why I'm saying that. So who learns quickly, right? I just mentioned it, kids. They learn very quickly. So like me, you probably learned to ride a bicycle when you were very little. And I haven't ridden a bike in a long time, but I can hop on a bike and I can ride that bike pretty quickly, right? It doesn't take me much time. You pedal, it goes forward. You turn the handlebars to the left, it goes left, right, it goes right. Makes sense? But here's the thing. What if a bike didn't work that way? What if you hopped on a bike and you turned the handlebars to the left and it went to the right? What if you turned the handlebars to the right and the bike went to the left, the front wheel? So that's called the backwards bicycle. And you can see it right there on the screen. It's called the backwards bicycle. Now, after this video, go and Google the term backwards bicycle and watch the video. It is hilarious. It is it's so freaking funny. So the guy hops on this bike and he's, okay, I can figure this out. He literally he just goes right over it. Cannot get on this bike, cannot ride it to save his life. It takes him about, I think, 6 months to ride the bike. But once he learns how to ride it, he can ride the backwards bicycle. Now, let me ask you a question. What do you think happened when this guy got back on a regular bicycle to try to ride a regular one now? He couldn't ride the regular one because he had changed his mindset around the bicycle to when you turn left, it goes right. But he couldn't hop on a regular bicycle and ride it anymore because he had changed the way that he thought about the bicycle, right? It's the same thing about money, right? We're taught a certain way about money, right? Get into massive debt to support our lifestyle. Hey, a 30-year mortgage makes sense. That's the best thing to do. Get a great rate. Awesome. Hey, get a car with a loan. All of these things were taught. But once you learn or unlearn, I guess I would say, the other, a different way of thinking about money, the old way about money isn't going to make sense anymore. Does that make sense? That makes sense. So when you start to rethink your way about money and you understand how money truly works and how you can gain control of it, you're not going to want to go back to the old way of thinking about money or leveraging money. Okay. So that's what infinite banking does. Now, with infinite banking, one thing we're doing is we're changing where your money goes first. Because we're taught normally that when money comes in, it goes out to the debts. Okay, money comes in, mortgage, credit card company, car loan, the bank for whatever reason, all that kind of stuff, student loans. Then whatever's left, we take. Well, I'm going to flip that around for you. Where your money goes first is extremely important. Now, to understand why I'm saying this, I want to ask you a question. And I'm going to answer it, of course, here. Why aren't more people successful? I just said, 5% of 100 people will be financially secure in retirement. Why is that? Well, here's why. Here's the mysteries of money. So one, wealth killers, taxes. I don't mind paying taxes, but I'm more than happy to pay a lot less. But taxes steals wealth. Now, do you think taxes are going up or going down? Well, just look at our national deficit. I don't think taxes are going down anytime soon. Inflation. By the way, inflation is not rising prices. Rising prices is the result of inflation. Inflation is the inflating of the money supply, which further reduces the value of your money and the buying power. Inflation steals wealth and kills wealth. Volatility, the markets up and down, up and down, up and down. When things go down, they have to come back up 100% to get back to break even. Guess what infinite banking does? Removes volatility. Interest. This is about maybe 5 or 6 years ago. This is a stat that I found. The average US household, family household, paid over about $18,500 in interest every year. Holy cow. Over 30 years, that's a lot of money that's not going to you. It's going to somebody else and making somebody else wealthy. Mindset, following the status quo, right? When we follow the status quo around money, especially, right, it definitely makes no sense when it comes to money. Fear is one of the biggest killers of wealth. Life in general, by the way, life teaches us a certain way about money that might be wrong. And then, of course, what we're taught when we're young. We're taught, by people that might not understand how money works. And then we take that same knowledge and apply it to our own lives and the same results, right? So those are some of the mysteries around money about why people are not more successful. Now, let's talk about what is the definition of money? Well, it is just a means for exchange. That's all that it is. Just a means for exchange. What company, by the way, uses compound interest? So do banks use compound interest? No, they don't, by the way. People say, well, yeah, they do, but no, when you look at a bank, how they function, they don't use compound interest. They charge you interest, but they don't use it themselves, really. And so, like, what I mean by that is if you wrote your name on a $20 bill and went to the bank, gave it to the teller, would they put it in a box with your name on it back in the bank? No, they don't. They put that money into motion. Okay, they put it into motion to make more money. It's not compound interest, though. Okay. So let me ask you another question. Is $1 worth more today or in the future? Well, the answer to that is it's worth more today. To think about how many candy bars or marbles you could buy today versus 20 years ago with a dollar bill. Another question, will taxes go up or down? Well, they're going to go up typically, right? So what's better? If taxes are going to go up in the future, would you want to pay taxes on the seed, which is your dollars today, or the harvest, your money down the road? If taxes are going up, well, you want to pay the taxes on the seed, not the harvest, because taxes are going up. Okay. Now think about an IRA or 401k, by the way. Well, an IRA or 401k, you're trading strong dollars today for weaker dollars in the future. And you're compounding taxes because the taxes are going to go up and they're always going to be there. So think about that. Would you rather pay taxes on a smaller amount and have it grow, or have it grow and pay taxes on a larger amount? So if you do the math, you want to pay taxes typically on the smaller amount, the seed, okay? Also, are you going to wait to eat bread or milk or drink milk today or down the road? Now, what do I mean by that? So, do you want to wait 5, 10, 20 years to drive your car or live in your house? No, we don't. Here's the thing. So, we want to drive the car today. We want to live in the house today. But that's not what we do with money. So, we leverage or get into debt to drive a car today. But we take money and we sock it away for down the road. So people do things with money that we would never do with things that money buys. So as an example, you never would buy a loaf of bread or milk and put it into the freezer for 20 years and then eat it 20 years down the road. Okay. So we would never do that because it would be freezer burn. So what we're talking about here is using your good dollar today, right? And then paying back with weaker dollars down the road. We've been taught to do the exact opposite, by the way, the exact opposite. Okay. So what I mean by that is an example. Let's say you put a loaf of bread into a freezer and let it sit there. And then 20 years down the road, you open up the freezer and there's 2 or 3 loaves of bread. Does that seem like a better deal? Well, they're all going to be gross and freezer burned and not very good. So would you rather eat the loaf of bread today or down the road? It's today, right? So what I'm trying to explain to you here is how we look at money, like strong dollars versus dollars down the road. We got to flip that around. We want to use strong dollars today to live our life and do things today. Okay. And last, what do you truly know about your retirement account? What do you truly know about it? So what I mean by that is who controls the money? Well, it's not you, by the way. I mean, you can to a degree, but the IRS, the 401k custodian, the pension plan managers, they control your money and they're making money off of your money. Now, why is that? Control, once again, control. Okay. And also, by the way, you can also lose money in those funds, in those accounts, you can lose money. Now, I know I kind of threw a lot at you, but my challenge to you is this, is start changing the way that you think about money. Because once again, we've just been taught to accept that traditional way about money, that traditional mindset around money, but to build true generational wealth, to build true freedom in our lives, we've got to challenge those old concepts and really understand how money works. So now I want to share with you how money flows, because this starts to get you sort of thinking this way. Okay, so let's look at an example of buying a car, because we've all probably bought a car, whether it's cash or finance, and we've bought a car. So I want to kind of use this as an example of what I'm talking about. So let's say you're going to buy a car for $25,000. Now, doesn't matter if it's a Ford Focus or a Ferrari, same concept, right? But I'll use $25,000 for simple math. Now, let's say you have $25,000 sitting in your local bank making 4%. Okay. Now, maybe it's 4%, maybe it's 5%. It doesn't really matter. But let's say you have a really good bank that says, hey, I'm going to pay you 4%, guaranteed, by the way, which I don't think that even exists in a traditional bank, but let's just bear with me here, at 4%. Okay. And then you say, okay, wait a second, I want to buy this car. So you go to the bank. I'll be the banker. I'm Banker Brian. Okay. You go, hey, Mr. Banker Brian, I'm going to go buy a car. Okay. So I want to take my money out of the bank and go pay cash for the car. Okay. But I'm saying, well, wait a second here. Wait a second. You're earning 4% in here. Okay. What if instead of you taking the cash out, I'm going to do this for you. I'm going to give you a really special deal. Okay. I'm going to leverage your 25K. So I'm going to use your $25,000 as collateral for a loan. So you don't lose the $25,000 earning 4%, but I'll give you a loan for $25,000 and I'll give it to you at 6%. Okay. So here's the thing. Let's look at that scenario. So now you have 25K in the bank earning 4%, and you have a loan for 25,000 at 6%. Let's say it's a 5-year loan. That's 60 months. Okay. So let's look at 60 months of comparison here. So what is the monthly payment on the loan of $25,000? It's $483 per month. Okay. The future value of that money being paid back to the bank is $28,999. I'm going to round up $1 and just say $29,000, by the way. So the future value of the money you're paying back on that loan is $29,000. But here's the thing. The money in the bank, that's the collateral for that loan, earning 4%. The future value of that money is $30,525. You made $1,526. Is that possible? I just did the math right there. Is it possible to make money, make more money, earning 4% while paying 6%? I just showed you that yes, it is. Now, why is that? Why are you able to do what I just showed you? Well, here's the deal. On the loan of $25,000 that's at 6%, you're paying 6% on a smaller balance every month. So the 6% really is not 6%, by the way. It's a smaller percentage because it's a smaller balance every month that you're paying that 6% on. On the flip side, the 25K in the bank earning you the 4% is compounding because you're earning 4% on a larger balance every single month or year. That's how this works. This is why people say, why would I want to be the bank? This is exactly why. You can make money. You can actually make money in this scenario, okay? So let's talk about the money multiplier method. So there's three things we're going to be talking about. So one is going to be the machine, okay? The machine that keeps your money in use, keeps it flowing, keeps it in motion, all right? Now, when you do that, you can keep the money in your family's hands for the rest of your life. We're going to talk about the fact that this method is a marathon. It is not a sprint. It's a marathon. It's going to take a few years to fully build the system up. It's not get rich overnight. If you want the get rich easy button, this is not going to be a fit for you, just being honest. The last one is the millionaire, okay? Everybody's favorite topic. How do you really truly build that millionaire, that nest egg, that family wealth right there, all right? So let's get into the machine. Now, what is the machine? Okay, the machine is very simple. And this is, by the way, this is the product. This is like the engine that allows the infinite banking car to move. It is essentially a dividend-paying, permanent whole life insurance policy with a mutual insurance company, right? Now, you might be thinking, well, Brian, why in the world are we talking about life insurance? Like, why are we talking about this kind of stuff? Now, when I first learned about life insurance, by the way, I was pretty young. And I remember thinking to myself, I'm young, I'm healthy, I'm going to live forever. I don't need to worry about life insurance. And I'm like, and I also don't want to have this expense, like this monthly expense. But guess what? I'm going to change the way you think about this. So in a moment here, I'm going to change the way you think about this, because when you think about this, it's not life insurance, it's a wealth building vehicle. Okay. It's not like home insurance or car insurance, which are purely an expense. When you have these things in place, you have a vehicle for building wealth. Okay. Now, also, who do you think is the number one purchaser of dividend paying permanent whole life insurance policies with a mutual company? Okay. It's banks. So traditional banks, the banks you see on every corner in your hometown, they own more whole life insurance than they do their buildings and land combined. Now, gee, I wonder if they know something that we don't. And by the way, they quadrupled their holdings of this concept, of this asset, this valuable asset, since 2016. Gee, I wonder why. And guess whose money they use to do this? Your money. They're using your money to do this. So we're talking about doing what? Kind of doing the same thing the banks are doing, circumventing, by the way, the banks and taking back control. Okay. Now, once again, why do banks do this? Why do we want to do this? Well, there's some benefits, which I'll talk about here in a moment, but tax-free. This concept has been around longer than the IRS, longer than the tax code, which is pretty crazy. And it grows guaranteed tax-free, pretty credible. Let's talk about how the money flows, how our traditional money flows. Now, I mentioned we're already here. In this scenario, you're making more money earning 4% while paying a higher amount at 6%. Okay. So I showed you that works. Okay. Now, why does it work? Why does this make sense? Because you're in control of every aspect of what you see on the screen here. You're in control. When you're in control, you have the same benefits as the banks and you can make money just like the banks do. Okay. Now let's talk about the banks for a second here, because this is something I didn't really think about when it comes to banks and how they make money off of your money, off of my money. So let's just say that you have $100,000 and you put that into a bank, and let's just say they're going to be very, very nice. They're going to pay you 4%. Yay, good for them, right? They pay you 4%. Okay, but what do? They don't sit on that money. They put it into motion. They lend it back out at 7% on a home for a home purchase. But here's the thing. What happens in that transaction? Well, guess what? The seller who sold the home, who gets your money when you buy it, doesn't just sit on it. They take that money and put it right back into the bank again. Well, what's the bank do? Well, once again, they don't sit on it. They loan it back out at maybe 8% for a car loan. But what's the car company do? They put it right back into the bank again. It's a cycle, right? It's a cycle. Now, does the bank sit on it? No. Maybe you're doing a home remodel. Maybe you're doing something like that. You do a HELOC. Well, they loan it back out at 9%. Does the contractor sit on it? Do the employees of the contractor sit on that money? No, they do not. They put it right back into the bank again. What's the bank do? Lends it back out. Maybe a debt consolidation. Okay. What do the credit card companies do? They do not sit on it. They put it right back into the bank. So the bottom line, a bank is keeping your money in motion, but in your mind, your money is just sitting in the bank, just sitting there doing nothing. But that's not the reality of it. The bank is taking your money and putting it into motion to make more money off of your money. So how much risk is the bank taking here as well? Well, they're collateralized by all of these assets, so very little risk. Now, of course, banks do go under. That's because they do something called fractional reserve banking, which I'm not going to get into, but it should be illegal, by the way. It should be illegal. But bottom line, banks make a lot of money off your money. In fact, they make about 500% more than you do. So they're paying you 4%, but they're making about 20%. They're making 500% more than they're paying you on the same dollar. Now, by the way, this is not something I just made up. You can go to bauerfinancial.com and you can see it right there. Banks make between 400 and 1,300% on the money that you leave there. And you can go look, you can go look, I think, in history and see what they've made off of your money. It's pretty crazy how they do that, right? It's pretty disgusting. So once again, getting control back from the banks is extremely powerful. Now, let's look at the annual spending pattern of money. So I'm going to go through this one pretty quick because this is powerful, but I want to be respectful of you guys' time too. So I'm going to look at the annual pattern of spending the money that comes into your hands every single week or month. So of every dollar that comes into your hands, around 20% of every dollar goes to automobiles, payments, gas, upkeep. 30 cents of every dollar goes to housing, mortgage, rent, things like that. 40 cents of every dollar goes for everything else: travel, entertainment, food, etc. So bottom line is this: 90 cents of every dollar that you make goes to other people, makes other people money. You're giving your money to other people. And 10 cents, around 10 cents goes to savings. That's pretty crazy. And by the way, about 3 years ago, it wasn't 10%, it was around 5 or 6%. And before the COVID recession, it was around, I think, negative. I think it was a negative number. So it's pretty nuts. And by the way, what do you think when you go talk to a traditional financial advisor? What are they talking to you about? Is it the automobile, the housing, everything else, or savings? No, they talk to you about savings. They say, put that savings into higher risk money because you need to get caught up and you're taking on more risk. But we don't want to talk about risk. So I'm not going to talk to you about the savings, what you're doing with it per se. I'm going to talk about the interest and what you're spending, because that's where you can take back control. All right, so 10% or 10 cents of savings. But now let's look at the automobiles. When you look at automobiles, here's the thing. Of the 20 cents that you go out, that's going out to automobiles, around 5 cents of that is interest. So what I'm going to go ahead and do is remove that 5% and put it over into your savings. Okay. Now, housing. 30 cents of every dollar you have coming in goes to housing, but 25 cents of the 30 cents is interest. That's a lot right there. So we're going to move 25 cents into your savings. And then everything else, that's around 40%, around maybe 5% of that is interest. And so we're going to take that and put it back into your savings. So when you control the banking functions in your life, all of a sudden, when you have the benefits, when you capture the savings or the interest into your savings, can you build wealth faster? Now, let me ask you a question and give me a one in the chat box if this makes sense. If you keep the interest and put it into your savings, are you going to have more money? Are you going to build wealth faster? I mean, give me a yes in the chat box if that makes sense. Will you have more money to build wealth? Obviously, yes, right? There you go. Brandon said yes. Lisa, yes. Okay, awesome. Yes, obviously, when you take back the banking functions, interest goes to you, you're going to have more wealth in your life. That's just the way it's going to work. Okay. All right. So let's get into the machine. So I want to show you how you can get all the money back for all the cars you'll ever buy, drive, and own. Now, this is just an example, okay? And yes, that's a Mustang right there. I love classic cars. I have I actually should put a picture of my car, but I have a Mercury Cougar that I restored that I love to drive. So, all right, let's go ahead and look at this. So this is what's called a policy illustration on the right-hand side. Don't worry about the numbers, but let's look under the hood at how this works, okay? Because when we think about life insurance, what do we think about? We think about premiums or expenses or a bill. Well, I want you to flip that around. When you look at a infinite banking policy, as we call it, the premiums are not expenses. It's a deposit because you can leverage that money. You can take it back out and use it. So it's not truly an expense. It's not truly a bill, right? Because you're funding your bank that you're then going to use to go do things like we're going to show you how to buy a car. So I'm going to call premiums premium deposits, okay? The next thing we talk about is age. When you hear life insurance, we think, oh, age, right? Oh, I can't do this because I'm too old or whatever it is. Not true. You can actually do this on other people in your family, business partners. Age does not matter. Now, yes, it can make the death benefit smaller, but once again, we're not focused on that. Now, yes, there is a death benefit when it comes to infinite banking structured life insurance policies, but it's not what we talk about or what we focus on. That's the end benefit, by the way. It's in benefit, but it's not the focus. If you go talk to a traditional life insurance person, they're going to say, how much death benefit do you want? You will never hear me or us ask you that question because we are looking at the banking functions of this. Death benefit is a side benefit because that is tax-free generational wealth guaranteed. Okay. So let's look at how you can recapture all the money you'll ever use or ever spend to buy a car. Okay, so let's look at an example. Now, this is, by the way, is just an example. I'm going to look at a premium deposit of $10,000 a year towards an infinite banking structured life insurance policy. Okay. And what I'm going to show here is at year 3, you purchase a car for $25,000. Okay. So let me repeat myself a little bit. So we're going to put in $10,000 into our infinite banking policy, our IBC, $10,000 per year for 7 years. That's going to accumulate what's called cash value. You'll see that on the right-hand side. These are very conservative numbers, by the way. Okay. Then we're going to borrow $25,000 from our infinite banking policy at year 3. So what does the math look like? Okay. Now let's, oh, sorry, I forgot about this. We're also going to pay back our bank, right? So we borrowed 25K. We are our own bank. So we want to be a responsible banker. Make sense? We're going to pay back our policy loan of $25,000 at $500 per month. That includes interest. That's $6,000 per year for 5 years. At the end of the 7 years, we have put $70,000 into this policy. We've also put $30,000 in to repay the $25,000 loan back. That's $100,000 that went into this infinite banking policy. Yet here's the thing. We also had $25,000 of cash that we took out. So we had that cash in our hands. Now we used it in this example to buy a car, but you could do whatever you want with it. You could pay down debt with it, which we'll show that in a moment. You could pay for college. You could invest in real estate or whatever you want. But you had $25,000 in cash. So in reality, you put in $75,000 into this infinite banking structured policy. Now, the cool thing though, is that you've recaptured though 91 cents of all of that money going into there because you have $67,881 in cash value inside this policy, which means you have saved 91 cents of every dollar you put into this. Now, let's fast forward. In year 8 through 12, we put no more deposits in. So no more $10,000. We put 0 in. Now, by the way, I would recommend you keep putting the deposits in because the more you put in, the faster it does grow. But let's say you don't put anything in there in years 8 through 10. But guess what you do? In year 8, you buy another car for $25,000. So what does the math look like now? Well, you pay it back like we did in the first example, the first loan or the first car. We put in $500 per month, $6,000 per year. So you've put in $30,000 in years 8 through 12. Okay. But you've also taken $25,000 out again. So how much did you actually put in to this policy or into infinite banking in years 8 through 12? It's $5,000. But guess what? It grew by $23,592. So you actually put in 5, but you had 23,000 of growth and you had the car. So who here would like to put in $5,000 into a vehicle or a financial instrument and get $23,000 of growth? Would that be good? Is that a good cash on cash return? Absolutely, right? I mean, if you guys like that number right there, put a 1 in the chat box if that makes sense. You want to have that kind of return. That is a very good return on your money. Now, by the way, this can work with just about anything. If it was real estate, if it was, an investment opportunity, something like that. This can work for anything, by the way. I'm just using a car as an example.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Now, let's kind of talk about, there's 3 rules when it comes to infinite banking that we emphasize. One is this: pay yourself first, because we've been trained to pay all of our bills first, and then we take what's left over and we put that into savings. But that is the wrong way of thinking about money. Paying yourself first, it means that you put your money into savings first, then you pay your bills or do the banking functions in your life. Second, pay yourself with interest, because if you have to pay the traditional bank back with interest when you take out a loan, you should be an honest banker with your own bank and pay yourself back, your own bank back with interest, because you can't recapture wealth, recapture the banking functions if you don't do that. All right. And then last is recycle and recapture your money. Now, would you agree that it's better to pay yourself interest than the bank, right? So yeah, so rule number 3 is recapture and recycle your money, because you're going to get more out of these loans from your own bank than you would a traditional bank. Now, if this works for a car, what else? Now, this is a real example, by the way, of a client that we put together. Now, this person used infinite banking to pay back a significant amount of debt. So this is a doctor, a 45-year-old doctor, 9 third-party debts. The total debt is $478,000 and change. And so they said, okay, can I use infinite banking to recapture and pay this debt back? The answer is yes. Okay, so here's the deal. So when they first came to us, the total payments they're paying out per month was $5,777 per month, or $69,000 per year. And guess how long it would take them to pay back all this debt? About 19 years. That's a long time, okay? So what I'm going to do is show you how they're going to take $25,000 and put that into an infinite banking policy to recapture their money and their debt and pay all of this back in just 7 years, and have a lot of value and a lot of assets at the end of those 7 years. All right, so they're going to put in $25,000 into the infinite banking policy in the first year, year 1. Now they're going to have immediately around $15,000 of cash value. Typically, it's a bit more than that, by the way, but we're being conservative. But they're going to have about $14,863,000 of cash value they're going to borrow out of that policy. And so what are we going to do with that money? Well, we're going to pay off the Discover card, the Lowe's card, and part of Nordstrom's. Our monthly payment goes down by $448 per month. Now we're going to take that $448 and we're going to recapture that money. Remember, we said recapturing. We're going to recapture that $448 back into maybe it's going to be a segregated bank account, or put it back into our policy loan that we just took out from our infinite banking policy. Okay. Now in year 2, what happens? Well, we put an additional $25,000 premium deposit into our infinite banking policy. We immediately have $16,571 of cash value, plus we have $5,374 of cash value on top of that, because of the $448 that was going back into our policy or our separate account. So we have a total cash available of $21,945. So what do? We take that, we pay off the Nordstrom card, Wells Fargo, the private loan, and part of the BMW. Now our monthly payment drops down to only $3,800, and we have $1,917 that we have freed up that we're recapturing back into our segregated account or back into our policy loan. And our total debt is now only $378,000 to the third-party debtors or creditors. Okay. Now, year three, same thing again. $25,000 goes in. Cash value that we get out of that is $25,541. Our payments back to ourselves are $23,000 and change. So our total cash we have available is $48,545. Once again, what do? We take that $48,000 out, we pay off the BMW, pay off West Marine, pay off a portion of the condo. Our total debt is now only $283,000 to the third parties, and our monthly payment goes down to only $2,100, and we've recaptured $3,677 back into our policy loan or back into our separate account. Okay, pretty powerful. This is only year three, by the way. So once again, what have we done so far just in 3 years? We've put in $75,000 into this concept, into our infinite banking policy. We've taken out $55,000 via the loan provision. So let me ask you a question. If we have done this, now keep it in mind that inside this policy, it is growing, compounded, uninterrupted. There's dividends around 5% right now, by the way. So how much do we still have inside of our policy earning us dividends on our cash, into our cash value? So how much is left? A lot of people would say $20,000. That is the difference between the $75,000 and the $55,000. But in reality, because we are our own bank, it is $75,000 still earning us the guaranteed returns, getting us growth of our money. Yet we've also borrowed $55,000 because the $75,000 or part of it, the cash value, is the collateral for the loans. Now, if you don't know what I just said, it's fine. Don't worry about it. What's important to understand here is that you put in $75K. You're earning 5% on that, uninterrupted, compounded for the rest of your life. And you've also taken out $55,000 cash in your hands at the exact same time. Pretty amazing right there. So let's get back to this. So year four, 25 goes in, cash value immediately available is $26,304. Payments back to ourselves is $44,124. Total cash available, $70,439. Same thing. Borrow from our policy, wipe out a big portion of the condo. Our total debt is now $187,000. Now, in this scenario, the monthly payment does not go down. The reason why is because the condo and the house are amortized loans or amortized mortgages. When you pay the principal down, the monthly rate does not change. Okay, so keep that in mind. So year five is the same as year four, pretty much. 25 goes in, you have more growth though. So you have 27,000 available in cash value. Payments back to yourself, 44,000. Total cash, $71,225. So now you take that out, wipe out the condo, a portion of the house. Your debt is now 91,000 and change, and your monthly payment dropped down to only $1,221. That's going to the house, by the way. And your money that you've recycled back into yourself, back into your policy, is now $4,556. Now, the fun thing is that what we often do with these is that we will do more than one policy. So you reach a certain point between 5 to 7 to 10 years, you'll do a second policy. So in this example, this person did that. They did a second policy in the following year. So in the first policy, they don't put in 25 anymore. They put in $10,000, but they still have $13,092 of cash value growth. The second policy, $25,000 goes into that, the first year of that new policy, and you have $14,863 of cash value inside there. So the payments back to yourself that you've recycled are $54,000 and change. Total cash value available is $82,633. Okay, so what do? We borrow from that, wipe out the house, our monthly payment goes to zero, and we are now debt free. We are 100% debt free. Now, what do we do in year seven? In year seven, we take the freed up cash flow, recycle it back into our policy loan, pay off the policy loan, and at the end of year seven, debt free. You have a ton of cash value inside this policy because you have not lost that money. You've recaptured it. So now you can use it for building wealth, real estate, college, whatever you want. You also have, from day one of this concept, day one guaranteed generational wealth. So there's a lot of things going on right here in this. I wanted to kind of give you an idea though, kind of high level of what you can do with debt. So in 7 years, this person paid back over $500,000 of debt versus 19 years. 19 years the traditional way, 7 years with infinite banking. Now, if you're saying, well, Brian, how do you even map that out? What's the numbers look like? Don't worry about it. We do it for you. So we have a full team that will do all of this for you. We have a software that we have built that does all the analysis so that you don't have to think about how to flow the money through what I just showed you. So this is an example of our Debt Blaster tool right there that maps this out. Now there's a report below this that shows you the monthlies and what to do with it and how to flow the money. So you don't want to guess on this kind of stuff. Also, we have what's called our implementation team. They will create a blueprint for you for whatever you want to do. Maybe it's paying down debt. Maybe it's invest into real estate. Whatever it is you want, we will show you how to do it. So like you don't want to guess on this. Once again, do not want to guess. That's what we do. Now, what if you have no debt? Because people say, well, Brian, I don't have debt. What if I don't need a new car? Can I still benefit from privatized banking? And should I still become my own banker? The answer is an absolute yes, because once you paid off the debts, once you don't need a new car, then it becomes very fun because that's when you start to build wealth and build a legacy. Because right now your money might be going out to these debts or going out to other things. If it's not, that's great. But now how do we leverage infinite banking and start building wealth? So what are the ways you can do this now? So here's some ways to build wealth with infinite banking. So one, active real estate. So things like wholesaling, flippers, buy and hold, owner financing, commercial property. So think of apartments, mobile home parks, things like that. Maybe storage units, private funds, maybe passive real estate. So private lending, private funds to real estate investors, things like that. Business owners, a lot of business owners will use infinite banking to act as their own line of credit or take money in their business and put it into another vehicle to get it working for them. Maybe if you own a business and you don't have like a retirement plan or a way to, take money out of the business for the future, infinite banking is a great way to do that. Stocks and options traders. So if you're doing that kind of stuff, you can use this to actually fund that. Startups. We have a couple of clients right now that are doing startups. Pretty cool to watch what they're doing, but they're using infinite banking first to recapture that money so that it's never out of their control. At the exact same time, they're using it to fund their startup business. Things like equipment flipping. If you're like saying, what is equipment flipping? Well, we have a private group where they're doing forklift flipping. So buying, renovating, and then leasing or selling. So lots of options, lots of other ways to build wealth with infinite banking. So I want to give you some examples of what I just said. What are some examples of building wealth like with private money lending? So I'm going to use an example here. Now, keep in mind, this is just an example, round numbers. In this example, someone put in $100,000 dump in. So I'll get into how you can fund infinite banking in a little bit. But this person put in a $50,000 premium deposit year one and a $100,000 upfront single deposit into it. Okay. Now let's fast forward down the road. I'm going to fast forward down to let's use year 8 on this example. So in year 8, the cash value, the amount that they can borrow from the policy, grew by $66,722. All right. But they only put in $48,593. So think about that for a second. They put in $48,000, yet the cash value available they can take out grew by $66,000. So it grew by $18,000 more than what they put in. So that's a 37% cash on cash return. So give me a 1 in the chat box if you would like to have a 37% cash on cash return on your money. Give me a 1, give me a Y, give me a yes, give me a thumbs up, give me something in that chat box if you think 37% is a pretty good cash on cash return. It's good. Yeah. Brandon, Kamisha, yeah. It's a good amount right there, right? Yeah, Frank, yeah, 10, yeah, a 10 right there. Yep, it's good. But it gets better. Let's make that better. So let's say you're going to private lend the funds. So private lending, you're going to lend money out at maybe 12% to 15%. But here's the thing. So if you borrow the 66, or maybe it's the total cash value of 531,000, and you private lend it out at 12%, okay, you're making 12% on your money. At the exact same time, you're making 37% on the same money in the policy. You paid yourself back 5% to your own bank. So the total that you made cash on cash return is 44%. That's better than 37 even. So We did nothing different though, except where your money goes first. Where it goes first is so important. So would you rather make 12% or 44%? If you just private lend your cash, you can make 12%. By putting your money first through infinite banking and using this concept, being your own banker, you can make 44%. That is the power of infinite banking. Additionally, I say this is a marathon. Why do I say that? The longer infinite banking is in place in your life, the better and better it gets. Now, I'm not going to go through all the numbers, but this is over 30 years. Just a snapshot of a few years. This one is a $6,000 per year premium and a $50,000 upfront deposit. You can see how this thing gets better year over year. So in year 2, cash on cash of 21% and access to capital is 121%. That's amazing right there, right off the bat. In year 10, it's 54% cash on cash. Access to capital is 154%. In year 25, it's a 281% cash on cash return versus what you put in, and a 381% access to capital, meaning you're accessing a lot more than you put into the policy over the years. That's wealth building right there. Okay. So now let's talk about the millionaire, right? So how do you eat an elephant? We've all heard this answer before. It's one bite at a time. Additionally, the man at the top of the mountain. So like when you think of like the like someone else who's very successful, they're all at the top, they're at the top of the mountain, they're up there at the very top. How did they get there? They did not fall there. Okay. Same with the person eating the elephant. If they've eaten the entire elephant, that did not just, happen immediately. They had to start. So the guy at the top of the mountain, the man at the very top, the woman at the top of the mountain took that first step. Then the second, then the third, then the fourth, right? That's how you get to the top of the mountain. It takes that time, right? But it's not going to happen if you don't take the first step or the first bite in the example of the elephant. You've got to get started. That's my point here. Take that first step. Infinite banking is a way that you can get to the top of the mountain. That's my point right there. So here's a kind of a question or a saying that I like. Is it possible to owe no man nothing? Yes. So the machine that we just talked about, the machine, it works for debt and expenses, but it also works for things like vacations, homes, taxes. So it works for lots of things. Now, to really paint the picture of the millionaire. So let's look at the example of the homes that the doctor, the debt that he had. So if we paid back those homes as promised, like traditionally, right? The condo, $879 per month for 251 months is $220,000. The house, $1,221, 224 months is a total of $273,000. You will have paid over the time frame $493,000. That's money that you don't have anymore. It is gone out of your control. You have lost the opportunity of that money to make money for you. Okay? Is that building wealth? Is that going to make you a millionaire? No, it's not, because that money is gone. It's not working for you. Yes, you have the condo. Yes, you have the house. But here's the thing. If you paid yourself back, you'd have that money. Okay? By using the money multiplier, you're going to get that money back, but it gets even better. Okay? Because you're making interest inside your infinite banking policy, there's guarantees, by the way, those dividends, and I'm going to use 4% to be conservative. Right now, by the way, it's higher than that. It's actually higher. Because you're doing infinite banking, you're going to have $749,000 in your infinite banking policy, plus you have the house, plus you have the condo. So let me ask you a question. Would you rather pay $449,000 and have the house and the condo, or use infinite banking and have $749,000 and the house and the condo? Are you seeing how this can flip the game for you? How you can actually become a millionaire doing this method? That right there changes the game. All right. Now, additionally, building wealth, investing with infinite banking can really accelerate your wealth building. Yeah, Kamisha said yes, absolutely. So we also have tools that will show you what I just talked about. So we have what's called the gain projector. If you want to take that cash, that $749,000 you have in your policy and lend it out or buy cash flowing assets, things like that, we will show you the best way to do that with that money, with that cash value. This is called our gain projector, by the way. So we built this for our clients. So what we'll do for you, our team will do this, our concierge team, will take whatever your policy is and the investment and plug it into this to show you the best way to get the best returns out of the entire investment and infinite banking. So we will show you how to do all this stuff. Because here's the thing, I have come across, and by the way, I've worked with thousands of clients, by the way, with infinite banking. You'd be shocked at how many people have an infinite banking policy and have no idea how to use it because it was set up by their uncle or by, Bob down the road. Okay. We don't do that. We actually support you throughout your entire journey. So this is just one of the tools that we have for you. Now I'm going to get into some more of the things that infinite banking does for you and some of how we can help you do that here in just a moment. But really quickly, now that you have seen just some of what I've talked about, I believe that everybody should be doing this and should understand how to do this. And if it doesn't work for you, that's fine. It is not a fit for everybody. I will say that 100% upfront. It is not a fit for everybody, but for most people, it does make a lot of sense. Because if you can do this and you're not doing it, I mean, you're really stealing from the future generations because you can set them up to live a life that we did not even have access to because we didn't know about this. So here's the deal. You can go to brian.beyourownbanker.com, schedule a call with me. It's with me personally. Okay. It's with me personally. I will hop on a call with you, go through the questions you have, go through what this looks like. We can go through numbers, whatever you want, but it's a call for you. Because when it comes to infinite banking, I have to understand what you're trying to accomplish so that I can serve you the best. That makes sense? And that's what we truly believe here at the Money Multiplier. So once again, guys, go to Brian. I'll put it in the chat box too. brian.beyourownbanker.com and grab a time with me. So that's the link right there. Whoops. Okay, so there you go. Just go there, grab a time. There'll be some other links and things and resources if you want them, but you don't have to. Just grab a time and we're good to go there. So I love this image right here because one of the things that infinite banking truly is doing for you is it's making your money work for you because we're taught to work for our money. We're taught to go trade time for money, but when you understand infinite banking, you can flip it around so that your money is now working for you. And it doesn't matter if you're making $10 per hour, $10,000 per hour, infinite banking can work for you. So that is what it's all about, is getting your money working for you. All right. Now, by the way, here's some things we didn't talk about. There's the death benefit. I mentioned it before, but here's the thing. The death benefit is a guaranteed payout, tax-free at some point down the road. That is generational wealth right there. Guaranteed, day one. That's pretty cool. Why do you think wealthy families like the Rockefellers get wealthier every generation? It's because they have these kinds of policies on their entire family. And then guess what happens? Well, every generation graduates, as we call it, passes on, and the family gets wealthier because of the guaranteed death benefit. Pretty cool. Loans never have to be repaid. Now, I recommend you do pay them back, but I'll get into it in a moment, but they don't have to be repaid. You're in control. The growth inside the policy is tax-free. I like paying taxes, not really, but I understand you got to pay them, but I love paying them less, or love paying less taxes, right? And these are tax-free. The policies, as I mentioned before, are exempt from judgments, liens, court orders, creditors, divorce in most states. So it protects your money. We all want protection of our wealth. Tax-free income in retirement. Pretty good idea right there. I like tax-free income. So do you. You can use this as a vehicle to get tax-free income in retirement. All right. Now, I mentioned the generational wealth. So this is an example of a policy illustration. Now I build these for you, and you'll get these for you. So on this one, this person is putting in $20,000 per year. Okay, that's their premium deposit. You can see their cash value over there is $17,000 year one. That's pretty good. In year one, though, what's the guaranteed death benefit? $325,000. Okay. Now, Alex, you don't have to put in 50. This is just an example. Yeah, it's all built for you specifically. So good question, by the way. So someone asks, what if I don't have $50,000 to put in? Can I make a little deposit and build? Yes, you can. Absolutely. About half of our clients will put in a large amount up front. Half don't do it. So it's 100% up to you. It's built for your situation. Okay. But yeah, on this one, day one, not year one, by the way, it's day one. There's a death benefit. But did you notice something though? If you look at it in year 2, 3, 4, 5, it's always increasing. Like the cash value, it's always going up. So is the death benefit. On this one, in year 7, it's $499,000. Like that's a guaranteed generational wealth right there. Let's talk about the policy loans because you're borrowing from your own bank. These are called policy loans or the policy provision. Okay. These loans, they are guaranteed. You're not asking permission. If you have cash value, it's a guaranteed loan. Okay. There's no credit check. There's no approval. Just ask and you shall receive. These are considered, by the way, a liquid asset. So financial institutions, the government, they consider cash value life insurance a liquid asset. All right. The loans, they are private. They're private. They do not go on your credit report. That's a very important thing right there. The car loan, you go and borrow from your policy to buy a car, does not affect your credit. If you have a lot of debt, oftentimes your debt to income ratio is very high, or your credit is getting dinged because you have so much debt. If you move that debt to your infinite banking policy, a side benefit is your debt to income ratio goes down and your credit score typically goes up, by the way. So very, very kind of cool thing. There are no minimum or maximum payments. You are in control. If you might say, well, Brian, what's the minimum I have to pay back on my policy loan? Go to a mirror and ask yourself, that's who, right? What's the maximum? Same thing. Hey, what if I can't make a payment 1 month? Don't make a payment. It's up to you. Okay. Now the interest does accrue on a year-by-year basis, but once again, you are the one in control. It's why investors love infinite banking because you can borrow, you control the loan, then you go invest it over here into something else you control. You're in control all the way through the whole transaction. Like if you're borrowing money from a hard money lender for real estate, you have to abide by their rules. If you are your own hard money lender, you're the one in control. Okay. As I said, miss a payment, nothing happens. If you miss a few payments on your car payment, no car. They're going to come and repo it, right? With this one, nothing happens. Okay. Nothing happens. All right. Let's talk about how you can fund your bank. Okay. How can I fund or, deposit into my bank? Well, it can be done monthly, quarterly, or annually. That's your premium deposits. The minimum for those premium deposits is typically 10 times your age per month. If you're 30 years old, 300 per month. If you're 60, 600. Make sense? That's the minimum. Okay. What's the maximum I can put towards a policy premium deposit? It's going to depend upon your age, or sorry, your financial situation. So it's based upon the individual, gross income, liquid net worth, all of those things come into play. Business that you own, that kind of stuff. I could work with you and show you what those numbers are. Right. Now, on top of the premium deposit, you can fund your policy with an upfront large dump-in. We call that the dump-in. The technical name is single premium PUA typically, but you can put in $50,000, $10,000, $5,000, $100,000 into these policies. Now, why would you want to do that? Well, it jumps up the cash value very high because 90% of those go to the cash value and you get dividends every year on a larger balance and the policy becomes very efficient. When people see these numbers, they love to do the dump-ins because it really makes the policies efficient, but you don't have to. It's just an optional thing. Now, this is something that's very important. When you fund these policies with premiums and dump-ins, you're going to have cash value available within the first 30 days. Not 6 months, not 12 months, not 3 years. If someone tells you, yes, I can set you up with a cash value policy, you'll have cash value within 3 years, run away. That is not infinite banking, by the way. Infinite banking, true infinite banking, within the first 30 days. All right. Now, let me ask you a question. Would you put $1 in order to get $3 out? That's a pretty good cash on cash return. Now, why am I asking you that question? So this is where infinite banking, you've got to really change your mindset. Okay. You got to change your mindset. Would you put in $1 to get $3 out? Here's what I'm saying. So here's an example of a policy. Now keep in mind, these are just example dollars. premium of $10,000 per year. Okay, so they're depositing $10,000 in per year. The initial lump sum deposit dump in is $50,000. So they're putting in $60,000 into this policy year one. So look at year one right here. 60 goes in. At the end of the year, so these are end of year numbers, by the way, they have $55,000 of cash value. That's a 90 or a little over 90% cash value that they have available to borrow against with this structure. That's pretty cool. But what's it look like down the road? In year two, they put in $10,000 premium deposit. They have $10,607 of cash value growth. They're already positive cash on cash in year two, but it gets even better. In this is year 11, they put in $3,120. It drops down, by the way. You don't have to fund these things for the rest of your life. The premiums actually go down, not up, but they put in $3,120 and the cash value goes up by $10,590. Essentially a 3.5 return on their money. Okay, they're putting in 3,000 and getting 3 times that out. That's why infinite banking is extremely powerful and why it can build wealth like no other vehicle I've ever seen. Because one, you're doing all of this stuff at the exact same time. You're also acting as the bank. So you're getting all this growth inside the policy. If you borrow from the cash value to go do things like buy a car, pay for college, invest into real estate, none of the numbers on the screen change. Warren Buffett said this. It's an interesting quote. If poor people would just do what the rich do, they wouldn't be poor anymore. So now that being said, what I just showed you with infinite banking, it's not a fit for everybody. I'm not going to say that it is, but if you want to do this, if you want to learn more about it, once again, go to brian.beyourownbanker.com. The link's in the chat box right there, and schedule a call with me personally. Now, a question you might be asking is, well, Brian, why should I work with you? Are there others out there doing this? The answer is yes, there are other people talking about infinite banking. Of course there are. Now, here's the thing. Me personally, I've been teaching IBC, infinite banking, for over 7 years. I've built courses on it, done a whole bunch of stuff in this space, do it for myself, of course. But we here at the Money Multiplier, we have an entire team that works with you to set up infinite banking. It's not like, hey, here you go, sign it and go off by yourself. No, we have an entire team that will support you and work with you when it comes to infinite banking. Also, we have ongoing support. Our team is one of the largest producers of infinite banking in the US. So we have a lot of resources. We have a lot of power with the insurance companies because of what we do, but we have a lot of repeat clients and referrals. That's it. Because of what we do with our clients, they come back for more. So we have by the way, I personally have over 100 clients right now in underwriting. So I have quite a few clients right now in underwriting going through the process just because of what I've shared and what I've done with them. As I said, we do have ongoing support and services. So after you have an infinite banking policy in place, how do you use it to become your own bank? Well, we're going to show you that. So we're going to show you how to access the policy, how to pay it back, how to leverage the loans, all that kind of stuff. So you don't have to guess on any of that stuff. You have a resource with us and our team and myself. There's no cost. So a lot of people ask, well, Brian, how much do you charge for what you do? We don't charge. We do make commissions. I will show you exactly how that works if you want. But yeah, there's no cost to you. You don't ever pay us anything. All right. Another question I get quite a bit is IUL or VUL, are those vehicles infinite banking? That's indexed universal life or variable universal life. Flat answer is no, they are not. They are not. Okay. IULs and term insurance pay some of the highest commissions out there. Infinite banking, by the way, when we do this, it's about a 70% cut in commission to do infinite banking. Also, the Nelson Nash Institute, essentially the Bible on infinite banking, they do certify people for infinite banking. They're called IBC practitioners. If you get certified by them and you do IULs, they will pull your certification. They will not even allow you to touch IULs. And the most common conversion from one whole life to an infinite banking that we do is IULs, by the way. So there's other reasons why, but if you want to talk about that, schedule a call. But yes, IULs and VULs are not infinite banking. Here's one thing I want to make sure you mention is that one or two things are going to happen to us in life. And by the way, they're both going to happen at some point in time. One is we live. Well, as you saw with infinite banking focuses on living benefits, not death benefits, the living benefits. Okay, so are we better off with or without infinite banking in our life when we're alive? Okay, obviously better off with it. When we die, are we better off with it in place or not? Because generational wealth, guaranteed. Of course, we're better with it. So these two things do happen. So are we better off with or without it? One kind of thing, I've worked with a lot of people with infinite banking. I've done a lot of financial education. I do mindset training, things like that. I run masterminds. And I see two people. I always see two people. And by the way, when wealth is transferred, which by the way is happening right now, we are seeing it live. Go turn on the TV. I don't watch the news, but if you want to see wealth being transferred, oh my gosh, it is happening right now. There's a lot of good books out there that if you guys want to learn about those books. Yeah, the Fourth Turning, by the way, the Fourth Turning is a good book on what's happening right now. But it happens a lot faster, and we're seeing that right now. And so I see two groups of people. So group one is the one that's just like they're got their head in the sand. They're on autopilot. They're sticking to what they've always done, and they don't want to do anything different. They don't want to change. They're just they're doing the same thing over and over and over, and they're typically stuck. They feel stuck, but maybe they don't know it. When wealth is transferred, it is transferred or stripped away from this group. It's taken from this group to another group. That other group is group two. Group two is typically those individuals that they're seeing what's going on around them and they want to know more. They want to be on the winning side of the wealth transfer, and they understand that control is one of the most powerful things to maintaining wealth and keeping wealth. And so group two, which I want to be in group two is that 5% we talked about at the beginning of the presentation. They're the ones that are always learning and can adapt or change when things are changing. That's one thing that I have been able to do. I did it during COVID. In fact, one of my businesses in I think 2020 or 2021, 2020, I 5x'd a business revenue wise. When everybody else was closing their doors and going out of business, I 5x because I pivoted fast because I want to be in group two. Does that make sense? So I always look at group two as the ones that really want to level up, want to improve themselves, and are open-minded, and also understand that, hey, if I want different results, I've got to do something different. Like group one is that one, go it alone, just kind of beat your head against the wall, which is what I did for a long time, by the way. Did that for many years. I did that. But group two is the one that takes action. So here's the bottom line. Let's solve your problems. Infinite banking is about solving problems, overcoming obstacles, creating more opportunity and control in your life. So as I said, it's not a fit for everybody, but let's see if it is a fit for you. Okay. So last slide, and then we'll get into the questions. I love this quote once again. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So once again, guys, brian.beyourownbanker.com right there, and I'll put that back in the chat box again, and then let's get into this questions here. All right, Blanca asked, can you be your own bank with a permanent policy without taking a medical exam? No. The simple answer is no. You have to go through the medical check. But if that's a challenge, there's other ways to work with infinite banking. You can get a policy on somebody else, and you can be the owner of it, by the way. So kind of something I'll probably put another slide in here for it. When you have an infinite banking policy, because keep in mind, the life insurance is just the product. Okay, it's just the engine. Infinite banking is a concept. It uses the engine, the policy, but it is a concept. So think of infinite banking like a car, but the car can't go down the road and function and play the radio and the heaters and the air conditioning without an engine. The engine is the life insurance policy. So we've got to get the policy in place to have the car. Make sense? I like cars, by the way. So Blanca, so you have to have the medical exam unless you're, 18 to 25 years old. Sometimes it's not required then. But yes, you do. But if that's a challenge, we can always work with you on other ways to use it. Paul said, thoughts on creating policy where the payment remains the same throughout the policy, so 10K per year instead of falling off after 10. You can do that. Yeah. So Paul, it depends on age and how you're funding the policy, but at some point it does drop off no matter what because of the 7-pay MEC rule called the modified endowment contract rule. Yeah, we show it dropping off because what oftentimes people will do is they'll drop it off at year 11 and then go do a second policy. But yeah, I mean, and by the way, you can pay zero typically after year 7 to 10. You can pay zero if you so choose. But I like the way you're thinking, Paul, because yes, you like to keep money going into it because it's going to grow it faster. There's really no disadvantage to putting more PUAs in after year 10. There's no real disadvantage. It's just going to grow faster. So, but yeah, but you can also take that cash and go put it into a second policy with maybe a spouse or an adult children, something like that. And then Ephraim asked, there are also benefits in life if we need to use the benefits because of a life-threatening condition. Correct. Yeah, so that's not something we talk about very often, but there are riders called insurance riders on these policies that they're no cost. So it's called chronic illness, terminal illness, and medical condition, I think, are the kind of the three main ones. And so if you get a terminal cancer, a stroke, heart attack, something debilitating, if I think it's no, I think it's 2 of the 5 daily activities for living, which is dressing, feeding, bathing, continence, transferring, those 5 things. If 2 of those are impacted because of something, you can get a portion up to 90% of your death benefit while still alive, tax-free. So yeah, that's a huge benefit for some people. They're saying, oh my gosh, long-term care, things like that. But yeah, if you have terminal, something terminal happens and you say, okay, I want to, go do things and have, experiences for the next 12 months, you can borrow from your policy and go do that. Brandon, I'm 60. Am I too late? No, you're not. So, I mean, I'll be honest. So, in your late 60s is when it becomes a little more challenging. But I've got policies right now we're doing in underwriting right now on people that are in their early 70s. So, but here's the thing. So, you're 60. Let's just say you're 75, and it doesn't make sense. You could also do this on somebody else, spouse, adult, kids. So there's a lot of other ways to use this for generational wealth. And I'll talk about that. I call that the waterfall effect. So let's say you have a family, you have the parents, the kids, and the grandkids, and you have money you want to pass it on. There's multiple ways to do that. But you typically start at the top. That's with the patriarchs of the family. So let's say, Brandon, it's you. You're 60, that's fine. You have a policy on you, and you're funding that with your income, cash flow, whatever it is, assets. The beneficiaries are the adult kids, okay? So that's tax-free generational wealth. The second layer is you have policies, maybe you own policies on them. So here's the thing. So they can be the insured. So let's say Bob is your son. Bob is, let's say, 30 years old. You have a policy on Bob. You're the owner of the policy. He's the insured, and the beneficiaries are his kids. So that's 3 generations right there involved in infinite banking. Can you see how you can pass wealth on? That's kind of cool right there, right? So you can pass it on right there. And it's pretty amazing how that works. Then you can, the third layer is you can have policies on the grandkids. The beneficiaries can be you or the parents. And then when the grandkids, however many years down the road, have kids, they can then have their kids be the beneficiaries. You just went 4 generations deep with infinite banking. Can you imagine how you're passing wealth on? It's amazing. This is why wealthy families get wealthier, because they do this kind of stuff. It's called the waterfall effect. Brad, when you do a dump in, how are the following years calculated if your annual premiums are noticeably less? Do the MEC rules come ever into play? Yeah, they do. Yeah, so Brad, great question. So the MEC does come into play with dump ins. We sometimes have to use a 7-year term rider to bump up the death benefit for those 7 years to do that. You can do a $10,000 premium or even a $5,000 premium per year paid monthly, and a $20,000, $25,000, $30,000 dump in. So there's a ratio that we got to play with, but it's specific to each individual. So I hope that makes sense. Ephraim asked, does the insured has to have the income? Yes. Yes, that's a good question. So yeah, so when you get a policy on somebody else, the insurance company is going to underwrite them, the insured, not you. So if you're funding somebody else's policy, the person being insured is the one being underwritten. Now there are some gray areas on that a little bit, but yeah. Good question though. And then by the way, if you're insuring a minor, so someone under the age of 18, you also have to look at the guardians of that minor before you can insure the minor. So if you have a grandson who's say 5 years old, you have to look at the guardian, who typically is the parents, as for coverage first before you can insure the grandson sometimes. Okay. But if you have questions on that, we can always hop on a call and go through the details. Let's see here. Sheila, does the cash value increase faster if you pay annually? Yes, it does. Not a whole bunch, but yes, it does. The more important thing though Great question, Sheila. Is it day one when you put in, let's say you're putting in 1,000 per month or 12,000 per year. Okay. If you put in 1,000 per month, your cash value is going to increase every month. Okay. If you put in $12,000 day one, you're going to have access to the full cash value within the first 30 days instead of it building up over time. Now you can access a small amount every month and it grows over time. But yeah, you get more cash value growth if you do it annually, but you don't have to, of course. Art says, if I have an IUL that I want to convert to whole life. Yeah, that's the most common thing I do, by the way. Most common thing. And it's an interesting conversation when we're doing that. Had it for 8 years. I noticed I don't have access to my cash value until year 3. That's because it's not infinite banking, by the way. Yes, not IBC, but it's an IUL. IULs, just from their structures, are not infinite banking. I learned it's built on a term chassis. Yes, yep, it is, which is not great for IBC. It's not, because it's going to the cost is going to change over time. Most likely. Once again, I don't know. I can't see it, so going to change. I already have a whole life policy designed for IBC. It's a 75/25 front loaded with 15K PUA. Had it for a year and saw I already had 1,200 in my cash value. So if you put in 15K front loaded, you should have access to about 13,000. So you should have access to 13,000 within the first 30 days if it's truly an infinite banking policy. Is it better to cancel my current IUL and dump the surrender value of 7K towards my current whole life, or should I just open a new whole life? It depends. If your current whole life is truly infinite banking, it probably could not accept that money into it. It depends on how it's structured and who it's with. But sometimes yes, sometimes no. If the answer is no, what you could do is I would not surrender the 7,000 in the IUL because you could be taxed on some of the gains. What you do is what's called a 1035 rollover exchange, and it takes the cash value and puts it into your whole life with no tax consequences. Okay. So yeah, schedule a call with me. We can go through that. I can walk you through what it looked like, and I can look at the existing illustration and see what's possible for you. I'm currently starting my lending business into real estate investors and plan to use IBC as one of my tools along with my HELOC. Absolutely. Yeah. So I don't really talk about it in these presentations, but HELOCs or first lien HELOCs or all-in-one HELOCs combined with infinite banking, man, pretty phenomenal strategy. You can really open the doors up to building wealth and paying down debt so fast. I mean, I've had some clients, I mean, they're almost in tears when they realize what they can do in 24 months. They thought that they're going to be debt free in 10 years, and I show it in 2 years, and they're like, oh my gosh, like you just changed my whole life and what I was going to be able to do. So HELOCs combined with infinite banking can be very, very powerful, and we do have those resources. We have someone on our team that is very knowledgeable about HELOCs and helps our clients with that process. So yeah, very, very powerful when used right, though. And by the way, HELOCs are not for everybody, but as an example, for like the first lien HELOC, you have to have about a 40% debt to income ratio. So it's called a DTI, so 40%. And I've had a lot of clients come in and say, hey, I've got some cash, I've got debt, and I have equity, but I can't do the HELOC because of my debt to income, but I don't want to take the cash and pay the debt off. What they'll do is funnel the cash through infinite banking, capture the debt, put it into the infinite banking policy. But now what happened? The debt is still there. The debt is now just in their control in their policy, but their debt to income ratio, as far as the credit bureaus go, has gone down, and they now qualify for a HELOC. Completely opens the doors up. Pretty cool. Do the insurance companies offer all the living benefits like some of the IUL products companies? Well, I don't know. So Brad, IULs, we don't do those. Those are not infinite banking. We don't touch those. So it depends on what the living benefits are that you think that they have. But here's the thing to understand. An IUL is a derivative of a whole life policy. So why do IULs even exist? So one is they have a lot of fees. They're fee heavy, by the way. They can lose money, and they're tied to the market, volatility. And I've had a lot of people be very upset with the performance of their IULs, but that's aside. So typically they have the same benefits. So they should have the same things. Now, why do IULs exist? In the 80s, what was happening? Guess what came out in the 80s? Anybody want to take a guess as to what financial vehicle came out in the 80s? Anybody want to take a guess? I don't, yeah, actually, Brad, I don't know when IRS came out. So 401k. So 401k, yep, there you go, Andy. Yeah, so the 401k, which is IRS section 401-K, came out in the 80s. And in the 80s, we had high interest rates. So people were like saying, I'm making 18%. Oh my gosh, this is amazing. So guess what the insurance companies did? They created the IULs as a way to compete against the 401k. That's what they did. Now, let me ask you a question. Do you think a 401k is a solid investment strategy for your future? Most people would say hell no, because they've seen it go up, down, left, right. You have no certainty about a 401k. An IUL was created to compete against the 401k. So they're kind of the same vehicle. Now, they're both tied to the markets. So make your own determination. But yeah, IULs are not infinite banking as far as we are concerned. They do have some of the same benefits. But yes, as far as the living benefits, well, one, whole life has guarantees, whereas IULs don't. So there's some better benefits, I think, in whole life. But the other benefits, like the riders and things, they all have the same ones typically. So yes. Yep, not a problem, my friend. Yeah, appreciate that. Thank you so much. All right, guys. Any other questions? Otherwise, I will call it a day here. But I appreciate all the questions. I love it when we have lots of questions. There's a link right there if you guys want to talk to me. Any questions, whatever, however I can help you, by the way. Any questions you have about infinite banking, about HELOCs, that kind of stuff, more than happy to hop on a call with you and go through it. But yeah, thanks, Paul. Appreciate that. Yeah. And by the way, any recommendations on the presentation, things that you think should be in there around infinite banking, feel free to reach out to me as well, of course. And I'll put my email address in there if anybody wants to reach out directly. That's my personal email address right there as well. Susan, you're welcome. Thank you so much. All right, guys, thank you for being here. Let you get back to your day. Respect all of your time. Martin, welcome. Appreciate that as well. All right, guys, thank you so much. We'll talk soon. Hopefully, talk to you on the call. Oh, Abby. So yeah, so the replay, Sean, I think is going to be available. It's going to be in the YouTube channel. So Chris Naugle's YouTube channel. It'll be there, I think, within the next day or two. So just look for it there. And I think we're going to be trying to send out an email as well, I think, with the replay in it, but I'm not quite sure yet on that one. All right, guys. Take care. We'll talk to you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.